On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope everyone is well. Today we're going to talk about what Wall Street is expecting from the US market in 2026. It's very much been prediction season over this last several weeks, and we've seen all the gurus consult their crystal balls and firm up their forecasts for where the S&P 500 share market index will finish 2026. Now, the S&P 500 ended last year, 2025, at 6880, and the 17 estimates for the end of this year that I found range from 7100 to 8100. Now, that implies a gain of anywhere from 4% this calendar year right up to 18% this calendar year. And the median estimate, which 5 of those 17 are picking, so it's very much a popular one, is 7,700, and that suggests a calendar year gain of 12.5%. Now that is modest actually by recent standards, because the S&P 500 has enjoyed a stunning period of above average returns. Out of the last 7 years, 6 of them have been up years, and they've been up big. Apart from that one down year, which was 2022, and that's when interest rates were rising very aggressively, so that was a down year. But apart from that one year, returns over those last 7 years have landed between up 16.3% to up 28.9%. It's been a staggeringly prosperous period for US share investors. And that does make me wonder if there could be a bit of recency bias that is playing a part here with these forecasts, because strategists who are all human like the rest of us could be assuming that what's happened in the very recent history will continue to happen. So I took a little bit of a look further back, and when I go back to 1950, the average return over those 75 years from the S&P 500 is a more modest 8.1% per annum. Now that's price only. If we want to include reinvested dividends, then that jumps up to 11.3%, which is pretty healthy, double-digit return. Not bad at all. Whether it's the low 8s or the low 11s, that's not bad at all. But here's the thing. The US market rarely delivers an annual return that is anywhere close to that long-term average. In those 75 years since 1950, there have been just 4 years where the price return was in that range of 7 to 9%, despite the average over that entire period being about 8% before dividends. Now, for the other 71 years, so that's the other 95% of the time, returns were outside of that range, either up or down, and often by quite a wide margin. There were 20 down years, that's about 1 in 4, including 9 double-digit declines and 3 declines of 20% plus. Those were 1974, 2002 and 2008, all very tough years. On the other hand, the market has gone up most of the time. Out of those 75 years, 55 of them have been positive years. So that's a hit rate of about 73%. Again, pretty healthy. There were also 17 years where US shares rose more than 20%, and another 5 where the US market was up 30%. So the lesson is very simple. The long-term return from shares is fantastic, but year to year, they really can be all over the place. I can sympathize with many of these strategists, and I suspect a lot of them probably don't enjoy being asked to come up with end-of-year targets. Those are great for the marketing department, which is assured of widespread media coverage and interest. Anytime you say, here's such and such as a year-end target for the index, that's going to get some attention. So it's great from a PR perspective, but we really should not expect anyone to nail these calls, not consistently at least. And that uncertainty is reflected in the almost 15% gap between the highest and the lowest forecast of this year. When some of the smartest brains in the business with ample resources arrive at such different conclusions, that really does tell us that there is a wide range of potential outcomes. So just be aware of that. Another notable point from this year's batch of forecasts is that nobody is really very cautious. No one is picking a down year. That was the case last year too, and everyone turned out to be correct, but in the previous 3 years, there was always at least one strategist that was brave enough or contrarian enough to predict that the market would fall. That's not been the case this time, and that's interesting in itself. I guess my overarching point is just to leave you with the knowledge that these forecasts are a bit of fun, they're interesting, they provide a bit of a guideline, but don't live or die by them, don't put too much weight on them. People will readjust these as new information becomes available, so they'll be fine-tuned, they'll be tweaked as 2026 progresses. So they do reflect what people believe and expect at a particular point in time. I think it was Laurie Calvasina from RBC Capital Markets that last year said something that I think described these very well. She said these are a navigational tool, but they're more of a compass than a GPS, and I think that sums up how we should view these. Thanks for listening, team. Enjoy your day, and we'll talk again soon.
For more insights, visit craigsip.com.